Inflation is finally cooling, markets are rising again, and everyone seems a little more relaxed. So, is this the moment to go all in on your investments? Or is this actually the perfect time to quietly fix the basics you might have ignored during all the chaos? Let's figure it out. When you hear that inflation is cooling, it's easy to get excited. But what does it really mean? It doesn't mean prices are suddenly dropping back to what they were 2 years ago. It simply means that prices are still rising, but at a slower pace than before. Think of it like driving a car. You were going 100 miles an hour, and now you've slowed down to 50. You're still moving forward, just not as fast. So even with cooling inflation, your salary, your rent, and your groceries are all still part of this new higher cost reality. It's not just about the stock market. It's about your everyday life. So why do the markets get so excited about this? It all comes down to fear. When inflation is high and rising, central banks tend to raise interest rates aggressively to slow things down. That makes borrowing money more expensive and can spook investors, causing them to pull money out of riskier assets like stocks and crypto. But when inflation starts to cool, the fear of those aggressive rate hikes subsides. Investors breathe a sigh of relief, thinking the worst is over, and they become more willing to take on risk again. This renewed optimism is what often pushes stock indices and ETFs higher. That's the simple story of why the markets love hearing about cooling inflation. But let's be real. For most of us, the big question isn't whether a stock index will gain 12% this year. The real questions are much closer to home. Can my budget finally get some breathing room? Can I actually start building a real financial buffer now? Can I invest steadily for my future without feeling like I need to panic every other week? The answers to these crucial questions don't come from watching financial news channels. They start right at home with your personal finances. Your life comes first. The markets come second. So, what should you actually do? Step 1. Use this calmer period to fix your monthly money system. Instead of just letting money sit in your account and guessing how much you can spend, create a clear flow. The day you get paid, split your money according to a simple rule. First, cover your essentials, your rent or mortgage, bills, and groceries. Second, pay future you by automatically transferring money to your savings and investment accounts. And third, know exactly how much is left for your daily life and fun. A strong automated system is far more powerful than trying to react to every single headline. It puts you in control. Once your basic cash flow is solid and you have some savings, it's time for step 2. Start or strengthen your long-term investing. If you haven't started, now could be a good time. If you're already investing, consider increasing your contributions. The key here is to make it automatic and diversified. Set up regular, automatic transfers into broad market funds or ETF if those options are available to you. You're gonna need to chase the hottest sector or try to pick the next big winning stock. For most people, the real advantage comes from time in the market and consistency, not from time in the market. Your goal is to build wealth steadily and not panic when the next inevitable market scare comes along. Now for a really important one, step 3. Guard against overconfidence. It's human nature. When the news turns positive and markets are going up, we forget the pain of the downturn very quickly. People start thinking, things are better now. I don't need such a big emergency fund. And they might be tempted to turn that safety net into a risky investment. Or even worse, they might consider borrowing money to invest, hoping to catch the upswing. This is a classic mistake, and in how the next financial shock ends up hurting people even more. Your emergency buffer is sacred. It's there for emergencies, not for betting on the market. Keep it safe and separate. So after all the headlines change and the news cycle moves on, what's the one habit that will keep you on track? It's simple. Create one monthly habit, a personal money check-in. Once a month, take just 15 or 20 minutes to review your budget, check on your savings buffer, and confirm your automatic investments are still running. Ask yourself one question. Am I a little bit safer? and a little bit more invested than I was last month? If the answer is yes, you're winning. Markets will rise and fall forever. That's their nature. A consistent, calm process will give you a lifetime advantage. Please remember, this video is for educational purposes only and is not financial advice. Thank you for watching. And follow for more calm long-term guidance when the headlines get loud.